Sir, please start.
Good evening, friends. I am KK Gupta here, your host. I am a director in Association for Financial Services and also director in research in India. This is our 24th webinar. We have already done 24th webinar. Now it is 25th. We are entering into that. So different subject we are sharing with our members. We have more than 400 members under the associations. So in different subject in every week we are trying to do it. Today webinar is most important webinar where more than 600 registration already done beside YouTube, Facebook and LinkedIn. The subject matter is very important. So business valuation for startup. The startup are facing very big problems because they have no any past experience or past records for that, any financial statement. Only they are depending on the DPRs. They are preparing some DPR and coming to the investor for investment. Their qualification of DPR is the most important aspect, where they consider the valuation aspect. I think some we have also held webinar in respect of a startup, where we invited the startup people and also investor also. So we also discussed in a details what are the difficulty envisaged by the startup to have evaluations. So we deemed it fit that we should organize this webinar where the eminent speakers like HP Kumar, who is the ex-chairman of the National Small Industry Corporation, is with us. And we are with us Mr. Ankit Goyal. He's founder partner of Double Valuation Professional, who is expert on the fields. And we are having Mr. Manish Gadia. He's a partner is JMP Associate, who is also day to day doing valuations and having a very practical knowledge in respect of that. They have done a big valuations in respect of intangible assets also, because intangible assets or goodwill, other things are very important role they are playing it to have a you can say for the valuation. Even you find that some units or some parties are suffering, are not having a profit, still their valuation is very high. Now we are going to discuss all these aspects. We are also expecting to join our Mr. Manoj, who is a GM and general heads of Bank of Maharashtra, Mumbai, who is the biggest zone of the bank, and we are also waiting for him. So this valuation aspect, what we are talking about the startup or other things that we are going to discuss in details for that. So any questions from your side, please put on the chat box. So we will try that we can give you proper answer to that question. So you know that in the developing nations, for any credit facility or any things, valuation, either you're talking about the assets valuations or you're talking about the on the basis of the income projection statements, that valuation, or any other aspects that we are going to discuss in detail. So as you already informed you, that Mr. H.P. Kumar, Dr. H.P. Kumar is with us. Mr. Kumar has been chairman cum managing director of the National Small Industrial Corporation Limited, a public sector corporation of Government of India for a period of 9 years till 2014, and has a rich experience in promotion and development of macro, small and medium enterprises throughout the country. Dr. Kumar is a postgraduate in commerce and qualified banker, CAIIB, uh, and follow post cost and management accountant of India, and hold a doctorate in employment creation through rural industrialization. Besides having been head of the finance and CEO of the large public sector corporations, he also held a foreign assignments with numerous African countries. He has been member of the National Small Business Advisory Council of South Africa and visiting faculty uh, of Banking, South Africa, and Boston Institute of Bankers. Dr. Kumar has a credit score of publication of the field of promotion and development of the macro and small industry and various government committee concerning the issues of SME sector. I think if I am going talking about the big list of his performance or award, other things he has achieved it. I will not take much time from this aspect. I'm only requesting Mr. Kumar, how you feel that for a startup to have the valuation. What is your views? What are the various reasons for a startup to undertake business valuations? Because startup is nothing. Only you can say their qualification or their thinking of the project report or DPR or something is available with him. Nothing. Only ideas are there. Now, to idea to have a valuation is very important aspect. So, what do you thought about Mr. Kumar for that? Hand over to Mr. Kumar.
Yeah, thank you and good afternoon, everybody, all the participants. Thank you very much, Gupta ji, for such an elaborate introduction. In fact, joining you and participating in your workshop is always a pleasure because you bring in very, very interesting subjects. The valuation the subject of valuation of startups itself is a very, very big field. As we all know that a lot of companies internationally as well as in India have become unicorns because of the valuation game. It is not because of their revenues or profitability. It is because of the valuation that the companies, many of them, have achieved huge amount of success in the financial world, and they have got recognition also from all quarters, from the people, from government, from stakeholders, everybody. Now, I mean, a lot of people don't know, in fact, what is valuation. How do these companies achieve so much of success? Now, take the case of a typical, company, old company, which has been doing substantial manufacturing and sales over the last 50, 100 years. The company is established by forefathers, transferred to the next generation and next generation. If they don't go for listing and valuation, naturally their value remains subdued at the book value. Whatever is invested maybe 50 years back, that remains as it is as per their book valuation, and you don't come out with the real worth of that company, whatever may be their achievements in terms of financial results over the last 50 years. But the moment you go for valuation, and why valuation will come little later, why valuation is done and what is the need for valuation, but the success of the valuation that I am talking. The moment you go for valuation of the company and you value that company in terms of the parameters which are recognized in the financial world internationally, you come to know that its internal value, intrinsic value is 100 times, 200 times, 500 times more than what is being shown in the balance sheet, financial accounts. And that is how the companies gain too much of large amount of recognition. Now, coming to why do we need valuations? Now, valuations are needed for many purposes. In fact, it started with the listing. If you want to go to public for raising equity, naturally you go for listing on the stock exchanges. And when you go to list the stock exchanges and you are divesting part of your capital, naturally you would like to divest it at the current value, not the value which is written in the balance sheet. If the value in the balance sheet is maybe 10 crores and your current valuation is 100 crores or 200 crores, naturally you would not like to divest it at the old book value. So it started with that. It started with the conventional method of valuing the company, taking into account the goodwill and the intangibles which the company has generated over the period of time. And taking into all those things, the valuation, started building up. And that is how the companies went for listing, to draw the current value of the company so that they can divest at the current value. But it has not stopped there. The new age companies, the startups, which do not have the background, which do not have the financial results or the legacy of 10, 20, 30 years, they have only the current last year, 1 year, 2 years, 3 years performance, and as Mr. Gupta rightly said, the potential of the idea which they have built. Now, whether this idea is in the form of an innovation, it is in the form of a new process or a new product. Any innovation which is recognized under the definition of startup and is basically not at the idea stage or not at the oral discussion stage, but it has been given a framework in the form of a company, whether the company has started operations or not, but it has given a frame, it has been practically, brought on the fore. It generates valuation, a different valuation of the idea, valuation of the future potential of the, success of that company or success of that idea. Now the valuations are basically taking care of the future potential, the future growth potential, the future profitability potential, the future revenue, the scale and the expansion of that particular idea. So it has shifted from the conventional book valuation to futuristic idea valuation, futuristic potential valuation. So that is, the transformation or the transition of the valuation which has taken place. The other aspect of the related to the valuation is the old businesses. Old businesses, if they really want to derive the current benefit of the market, naturally they need to value it. It could be for any purpose, maybe for the purpose of transfer of equity, maybe purpose of sale of company, maybe purpose of division of the company amongst the partners or the family members. Or so naturally they need to do the valuation so that they can decide as to, in the wealth valuation, as to what is the current value of the company vis-a-vis the other assets which they may be distributing to the family or the partners or family members. So that is another aspect which is related to the need of valuation, which is very important, of course, because millions of businesses value their business for this purpose, not for listing, not for raising capital, not for divesting their equity. So that is another area where valuation is needed. Now, of course, there is another aspect which is, even if you don't want to divest, you don't have to raise capital, but you want to enter into a club of the elite where people say that you have become a unicorn and you have become a rich company. So you want to generate the value of your goodwill and the scale that you have created, so you can value your company. That is basically not giving you any financial money, but at least the giving the recognition and the understanding of the people and your own prestige. That is also another area which is. But of course, I would say that most of the cases, the valuations are done for the purpose of raising additional funding and divestment. And that is how, if you want to scale up your business, particularly the startups, when they start at a lower level, naturally they would like to go for scaling up and expansion of their areas. For expansion and scaling up, they need additional resources, funding. And whether it is starting from, round one angel funding or round one, round two venture funding, naturally at every stage, the valuation is required. And that is how you can value the company. But it's a matter of, pride for Indian companies, Indian startups, that they have achieved valuations, substantial valuations. I know companies starting only 5 years back and they have got a valuation of $5 billion, $5 billion in 5 years, six years. So that is the kind of, power that the valuations have. Now, how do you value a company? There could be various methods. I'm sure our distinguished members of the panel would be able to throw light as to how do we value. But one company that I am associated, we valued that company, two companies particularly. We valued that company on the DCF method, and we found huge potential of the valuation. I mean, you can't even imagine, and we were very happy to see the valuation. In fact, in terms of the actual, I don't know whether we'll be able to get that money or not, but at least you feel happy that, okay, you can have that kind of evaluation at a time to come. So I'll stop here And with this introduction, I'll give it back to Mr. Gupta.
Thank
We'll
you, sir.
continue to be associated whenever there is an issue.
Thank you, Mr. Kumar. I think you've taken very rightly step forward. You're talking about the traditional to futuristic. I think this a new concept has come from a traditional, even a new startup who had not done anything. Even he have only experience with him, or a project report with him, or some idea is there with him, or innovation is with him. So he's investing to the investor. And investors are considering their proposals. What you're talking about the discounted cash flow, and accordingly the valuation is also accepted. Major aspect is the assets valuation. We are talking about the income valuations, and we are talking about the market valuation. Are the three valuations are more important, which a startup have, I think we are starting, because we are confining to startup. Even if for a commercial, for a corporate loan, the bank is insisting for the valuations. So what do you feel that evaluation is a must for any corporates to approach to the bank for taking a loan or something like that?
So it helps. It will benefit as long as you are able to show the real worth of your company by
Okay.
revaluing the assets of your company. Revaluing the, when I say assets, revaluing the entire business, not only the business. Because asset valuation is only one part of the valuation.
Okay.
The valuation of the potential, valuation of your business in terms of achieving the success in another 5 to 10 years will surely help you in putting your sound credentials before the bank, who will be interested in knowing as to whether you have the future repayment capacity or not. So naturally, if it is positive and your valuation, future valuation is more than your book valuation, it is going to help you. And you should understand, of course, if it is a loss-making company and future is also going to be loss, better don't value it. Naturally,
Correct.
it is going to be lowering your even book value also. But naturally, when you are going for loan, you will be scaling up and expanding your business operations and achieving some kind of profitability in future, which will surely give you a positive outcome.
I agree, because the when we are talking about the book value after providing depreciation or something like that, the value in the books of the accounts has quite a reduced for that. When we are going to for a valuer for having the assets value, even goodwill value, even other things are valued, or intangible assets value, that he also considered to very huge amounts are coming, and it will be eye opener for us. So
Yeah.
for that intangible, what you're talking about the intangible, now I'm coming for the intangible valuations to Mr. Manish Kedia, Gadia, sir. So he is chartered accountant. Manish Gadia, having 24 years of professional experience as chartered accountant, having professional experience in the field of audit system, management consultancy, finance, taxation, matter, worked in different industries like garments, engineering, tourism, retail industry, providing different services like preparations and system manuals, tax planning, financial consultancy, business plan, due diligence, merger and acquisition, etc. He has been successful completed business valuations and project report preparation of the variety of industries. He also holds qualified information system audit certificate from the Institute of Chartered Accountant of India. His contributions are stepping stone toward the success of the firm in providing services to its wide area of clients. He is the president, View Exchange CA Study Circle from 2016 to 2017. He is a speaker in the various valuations, whether you are talk about the security or financial aspect. I think the right person talk about the valuation aspect of the corporates. When we're talking about a corporate, either it is a assets valuation or a block assets valuation, or we are talking about the intangible assets valuation. Mr. Gadia sir, have any view on that, some intangible valuation? How it is helpful to a corporate, sir? Mr. Gadia.
Yes, sir. First of all, I would like to thank you, Association of Financial Advisors of India, Mr. K.K. Gupta ji, for giving me opportunity to express my opinion on startups and intangible assets. So it's a very nice subject and very new subject. And regarding startups, the value mostly comes from intangible assets. So it's a new world, and the time has been changed. Earlier, there was time for tangible assets. In 1975, most of the value was coming from tangible assets. Almost 85% value was coming from tangible assets and 15% value was coming from intangible assets. But after 50 years, the time has been totally changed. Now the 85% is coming from intangible assets and less than 15% is coming from tangible assets. So now we have to think over this thing. The world has changed. So we have to focus maximum on intangible assets because the value is creating from the intangible assets. So there are a lot of forms of intangible assets. So we have to consider them and what are the factors which affects the valuation of these intangible assets. So let's consider these things. So there are lots of forms like goodwill, patent, copyright, trademarks, brand building, customers list, and some other aspects also of intangible assets. So all these intangible assets affects the valuation of the startups or any business enterprise. So what are those factors? So we'll discuss few factors one by one. First and foremost factor, which I think very important for any intangible assets for any business enterprise, is the core competency. What is the core competency or what is the strength of any business enterprise? So we have to consider these things. If we take any name in an industry, what comes in our mind regarding that business or industry? Suppose we take a name of any shoe company. So naturally, in our mind comes the name of Nike or Adidas or Puma, something like that. If we take name of any ethnic wear brand, so naturally Manyavar comes in our mind. Manyavar is the ethnic wear brand, so that is their core competency. And after that, we have to consider what is their competitiveness or what is their strength, what is their organization structures, what is their employee manpower strength or their skill building or their what is their strength of the manpower, that we have to consider, that helps in building the intangible assets. So and what is their share in the industry, that also we have to consider whether the company or company is having a good amount of share in the industry. What is their famous brands or how much patents or copyright they are holding in their name, that helps them build the intangible assets. And whether the company is having monopolistic structure or there is any entry barrier in that industry, whether new company can come in that area, in that business or not, and what is the research and development status, how much amount the company is spending on research and development. So that we need to consider for valuing intangible assets. And what is the government support provided for that particular industries, what is the locational advantage of that company, of means how much locational advantage that company is having, whether that company is having any tax-free benefit in that particular zone or not. So there are a lot of factors which have to be considered while valuing intangible assets, because that affects to increase the value of any intangible assets. So if we think of these intangible assets, now 85 to 90% of the enterprise value comes from intangible assets. So if you can tell me which is the biggest brand in the world, what are the top 100 brands in the world whose valuation is highest? So which brand comes in your mind? Biggest brand. Naturally, I think all Apple is the biggest brand in the world, in today's world. But if you can name me any one brand which comes out of 1 to 100 in the total list of the world's top most valued brand, there is only one brand in the whole list, that is only Tata Group brand. that is having valuation of roughly $25 billion. So apart from that, there is no such brand which has been created in world atmosphere. And there are some other brands also in India like Infosys, Reliance, or TCS, like these brands. But maximum value is coming from intangible assets. So company has to think of creating intangible assets by uh, doing lot of research and development activities, and improving its productivity, improving its manpower strength, building skilled manpower. So these activities affects lot in building intangible assets. So these are my opinion on intangible assets. So Gupta ji, I think if anybody can help to which who are having more factors which affects the intangible assets valuation, they can also point out.
Gupta ji, you can unmute yourself.
Sir, Bagadia sir, but I'm talking about, so
Yes, sir.
intangible assets is part of the balance sheet.
Yes,
What
sir.
you are talking about, it is off the balance sheet. When you are talking about the copyrights, you are talking about the consumer leads, you are talking about the core competency, you are talking about strength of the staff or something like that.
Yes, sir.
It is, I think, all balance sheet things are there. How you value these aspects, sir?
Sir, valuation means how to value these intangible assets. That is a separate area. So there are different methods to value these intangible assets. Normally, we, as per international valuation standard, there are 3 valuation approaches.
Okay.
First is cost approach, cost to duplicate, how much cost has been incurred to means build these intangible assets. That is normally not considered. And other aspects are other valuation methods are comparative company valuation method. So that is also not very much considered. Normally, income approach is considered. In an income approach, there are normally relief from royalty method are considered. How much patent, copyright, or the trademark intangible assets add value in the company's value. And apart from that, there are multiple excess earning methods also considered, and with and without method is also considered for valuing these intangible assets. So by applying this,
sorry for that,
yes,
I'm just interrupting you. You're talking
sir.
about the income. You're talking about the income approach.
Yes,
To
sir.
such a form, I've seen that they are incurring continuously losses.
Okay, sir.
Still, their balance sheet, their valuation aspect is very, very high because their customers are there or something other things are there.
Yes,
How
sir.
the income that the income is not playing a role for the valuation aspect in that company?
Yes, sir. That's right, sir. In case of newly started enterprises, so normally they burn lot of case to build that brand. So in that cases, there are some other methods also there, like how much customers or subscriber base is there. So suppose Facebook acquired this WhatsApp company. So WhatsApp is still not having an income, but still WhatsApp is having so much big value.
Yes.
So in that case, we have to consider some other method, like what are the subscriber base of that company, how much customers are there, uh, what is their future projection. We can also consider if their company is having any other income source or income planning. Like in case of Zomato, also the company is still having loss, but it's there is a huge value in Zomato. So in case of Zomato, the valuation method is different, like how much active users are there. So suppose there are 4 crore active users are there, and every user is spending some fixed amount every month. So by multiplying these revenue method and some other advertisement method, the valuation is derived. So the value the market is displaying right now, suppose whatever amount Zomato is having right now, so that valuation is okay right now. So we cannot deny that Zomato is having loss, or there should not be any valuation for these companies. So there is a method for valuing every assets.
Then that Mr. Gadi, I agree with you. Valuation is a different method. Well, my point is very simple. When
Yes, sir.
you have no revenue, the revenue is not surprising. You can say incurring a losses for continuously for that, and you cannot service the debts even because there is no, you can say, income. So still valuation is there. However, valuation play important role in financing or something like that. In loss-making companies, so
Yes, sir.
how the banker will consider them as a fit for the giving the loan to them?
Yes, sir.
Because
Sir,
it's
there
not
are two parts of valuation normally we calculate. One is the normal business cycle, and then comes the terminal value. So in normal business cycle, suppose there is a normal business cycle of 5 year or 10 year. So in 5 year time, the company incurs lot of losses normally. But what will be the ultimate and terminal growth? The value comes
right.
from that thing normally. So
Okay.
we have to consider the terminal value. Normally in these kind of companies, the terminal value is the maximum value. 90% value comes from the terminal value. Only 10% value comes from the normal business cycle, suppose 5 year or 10 year times. In that period, company incurs maximum loss.
Very nice. You're talking about the 85% valuation is coming from intangible and 15% on the tangible assets. I think this is addition to my knowledge also because we are feeling that once you have a block asset, you are incurring a profit, you are having the revenue, then valuation will be much higher. Or you are talking about the EBITDA or the revenue, sale, other things, we are can consider it. Lekin what you're talking about the intangible has its own value. The major we are talking about the startup, Mr. Manish. So point is for a which is right time for the startup to approach the professional people to have a valuation people, license valuer, which is the right time for the startup.
Yes, sir. That's a great question, I think, because every time is a right time. So normally to do any right thing,
Yeah.
every time is a right time. Means when we
Okay.
should do anything, right thing. So right time is the right now. We can say.
Okay.
So in case of valuation also, there is no perfect time because it start with the inception of idea. So
Okay.
when idea is conceived in one person's mind,
Uh,
suppose that time there is no revenue, there is no history, there is no data available. Still, the idea can be valued, and that depends on certain things. The valuation method here is different than the conventional method, than the traditional method. Here comes the role of the modern methods. There are several modern methods derived for valuing these startups. So I have means segregated this valuation timing for startups in 3 zones, 3 stages. First
okay.
is childhood stage,
Uh-huh.
when the idea is generated only. Then comes the teenager stage, when the idea is growing at growing stage, and then comes the adulthood, means maturity stage. So we have to consider these startups at 3 stages. First is early stage, second is growing stage, and third is maturity stage, and last stage. So at all these stages, there are different sub stages also. Like in case of early stages, first stage is idea stage, and in all these stages, the valuation methods are different. So we have to consider these valuation methods also for all these stages. In case of idea stages, first the founder or the founder person thinks of this viability of this idea, whether the idea is viable or not, whether it can be marketable or not. So we have to think of and research, analyze these ideas, whether it can be production or some services can be required in the market or not. Then comes the prototype stage. If the idea is okay, it is a marketable idea, then the founder prepares a prototype of that idea and minimum viable products. It prepares it to launch in the market, to launch in some few relatives and friends and a very small group, to launch that product and service, whether that idea is, whether that product or service is viable or not. minimum viable product he prepares. Then comes the early revenue stage. Whether if the prototype is approved, then the founder starts some revenue or some traction has happened. If the some traction is happening, then some research and development and some means product fit is developed. कि उसमें कुछ if some changes are required in the coding or some pivoting is required in change, if some change is required in the idea, then it happens at the early stage only. Then some early revenue stage starts, means some revenue starts to generate. And in the first stage, normally the value is generated in the name of the if the idea is viable and marketable, and the promoters and founders are very means very famous and very reliable, the value happens in the name of founder and in the name of idea. And there are few methods in case of early stage, like the normally valuation happens in the valuation idea is valuation method is 5x method. Normally we call it ki how much the founder wants. Suppose founder wants 100 rupees. So the valuation happens at 500 rupees in case of early stage. So whatever the founder wants to raise, the valuation happens at 5 multiple of that requirement. It can be 5 or 4 or 6 can be there, but normally it's 5x method. Or there can be some exit route method also. So the calculation is different in case of this early stage method. Then comes the growth stage, when the idea is set and some early traction has started. Then the growth of that product or service starts, and there is a huge development or huge growth in that product and service. Huge revenue starts and profitability start to generate. The product starts to become the market leader. Then after that, the idea becomes the maturity stage, at adult stage. Then at that stage, the product and service starts to generate the profitability. And in these stages, growth and maturity stage, the valuation methods are very traditional type method. Here we can apply first Chicago method, where sensitivity analysis is done, like in case of DCF method. In normal tradition method, we prepare discounted cash flow analysis method, where we use only a base method. But in case of first Chicago method, we prepare 3 sensitivity analysis. Like first is the best method. What can be happened if the company achieves its maximum potential, full potential, then what will be the valuation? And in case of base valuation, what will be the valuation? And if the company doesn't perform well, what will be the worst case? And in all these cases, a proper weightage is applied to derive the value. So in case of growth stage, the company prepares the first Chicago method, or there can be some comparative company analysis also. If there are some comparative companies is available in the market, but there is a very few companies available in the market of similar kind. So the data is very few. So comparative company analysis can be done if data are available. Otherwise, DCF method can be applied. And in case of maturity stage, the DCF method can be applied, or some comparative company analysis or venture capital method can be applied. So these are some stages where valuation can be applied for startups, and some valuation method can be also applied to value these startups. But there are a lot of challenges also there to value these startups, because very few data are available to value these startups. Like there is no past history and data. There is very few comparative companies are available in market to value these startups. and the risk analysis is also very difficult to analyze what will be the risk associated with these startups. So that very challenges are there, and how much growth will be the startup will be achieving, how much growth in future. So we have to consider all these aspects and criteria, sir. So these are the valuation methods and stages.
Very nice, very nice, Manish. So
Yes,
you
sir.
have covered very little, but I'm thinking in respect of the assets approach, we are talking about the income approach, we are talking the market approach. For startups, nothing will apply for that. Even the investor, what we were talking about in our previous webinar somewhere, so investor are looking into their qualification, requirement, their product, their innovation. Then they decide the valuations. There is not a hard and fast method what they are telling to arrive any valuation of any product or something like that. I think I will come back to Manish later on. If any other thoughts from your side in respect of intangible or a startup, please, you want to explain, you can explain also because you are very thoroughly explain everything. What are the method and how it can be valued, how a startup can be benefited from that. I think you have covered everything. Now I'll come back to again. I'm coming to CA Ankit Goel. Goel Saab is a BCom, H, LLB, FCA, DISA, registered valuers, and insolvency professionals. So he is a speaker in various webinars, very founder partner of AAA Valuation Professional LLP, registered valuer, equity recognized by IBBI for all assets classes, land building, plant and machinery, securities and financial assets. With 23 partners, the firm is the latest in terms of number of partners and has conducted more than 1,992 assignments with the value of 41,000 crore. I think he is the right person to talk because he had done the valuation of 41,000 crore. So, Mr. Goel, what I am asking you, what are the challenges? Because Mr. Manish and Kumar Saab has set the tone for you. Because valuation being done by the valuers. Okay, you done 41,000 crore rupees valuation in respect of a different assignments. Have any challenges? What are you feeling as a valuer to value the assignments, to value the company, or value the enterprise, or value the block assets or intangible assets? So I
So
have.
thank you. So thank you, Mr. Gupta, and thank you. Thanks to Association of Financial Advisors of India to give me this opportunity to be amongst all of you and talk about the subject at hand. Business valuations have always been challenging assignments, primarily because the data that we use for valuation is prospective or it's projected data. I think the problem is very similar to that of all the banks, because when the banks are seeking to do an appraisal process of a company, they are looking at forward-looking data that okay, what will happen to this company after 5 years, after 7 years, after 10 years, what kind of cash flows will the company have in the future. Of course, like bankers, we as valuers are also expected to look at historical data. And when we look at historical data and compare the projected data with the historical data, the challenge that we face, especially with startups, is that startups are high growth entities. When we say high growth entities, we're talking about growth as much as maybe if the company was having a revenue of 10 crore rupees last year, next year it can have a turnover of 1,000 crores. But at the same time, if it grows its turnover by from 110 crores to 1,000 crores, it can also be possible that its net profit increases from minus 20 crores to minus 2,000 crores in the next year itself. That is how we define high growth startup companies, because the objective in the initial years is not to make profit. The objective of a startup entity in its initial years, even in the later stages now, is to capture market share and create a situation where you can launch a project, launch a product which can make which can become a habit for the consumers. And then, of course, the second step that is, or the most important part that is spoken in the startup culture is that you have to be solving a problem at hand. So Uber came up. Why did Uber come up? Because there was a problem at hand that a person who wanted to travel from one place to the other had to reserve a taxi. He was not able to get public transport easily. And now he can just switch on his app and get a taxi waiting outside his door the moment he is free from his work or from whatever he wants to do. Similarly, today there was a problem that an entity like Zepto discovered. Zepto realized that people can have a craving and they can want that craving to be fulfilled immediately. So somebody today wants Maggie and he's out of Maggie at his home. He can go to Zepto, order that Maggie, and it will be at his home in 5 minutes. And maybe now Zepto is not demanding a premium for fulfilling that craving, but maybe in time it when asked the purchaser to give a packing cost, to give a delivery cost over and above the value of the items that are being delivered to his house in almost no time. So people build business models which are innovative because they feel there is a need in the market for these options. Now, we were talking about, or you were a short while before talking about how can a loss-making company have a value. Now, today, earlier we used to say, okay, unlisted startups, there are so many examples where there are loss-making companies in which people are investing and investing like anything. But today, some of those startups have managed to list and they're still in losses. And if you read their prospectus, it's like company like Zomato or Paytm, their stocks might have tumbled or there might have been depreciation in their stocks since their IPO listing, but the stocks are still having a positive value. That means the investors and the market feels that there is a positive value for this equity, even though the prospectus and the latest financial statements of those companies keep declaring that we don't know when we will turn into profits or we will have profits. We don't anticipate that we will have profits anytime soon. This is the exact statement that is written in the prospectus of Zomato and Paytm, because they are still fighting to find a profitable business model even after listing on the stock exchange. So we are at a time where the hope that someday we will make money, someday we will convert this business model into a profitable model so that we can give back money to our investors is the norm. With startup culture, where for startup entities where the entities are not listed, the whole idea is to keep increasing value in every round. One starts with a small round, maybe an angel round, the friends family round, and we sometimes jokingly call it FFF, that is friends family and fools round. That in case you are investing in that round, then you are fighting a 1:20 probability to make any money at all. But I have seen many of my clients make money of very early stage investments where they have, say, invested 50 lakh rupees and they have sold their investment for 5 crores in maybe 6 months or 1 year's time, because that investment has then been sold to a bigger investor who has now valued the company at a higher value. That investor then exits at an even higher value. So the whole chain continues. The problem for the valuer continues. The valuer has to either trust the high projections, because at many times the valuer is approached only after the negotiation for that round of investment is complete. So how can the valuer say that no, this value is not recoverable? Because when the company comes to the valuer to get a statutory valuation or regulatory valuation, the company says we have an investor who is coming in with 1,000 crores investing at this value. Please certify this value. How do you say that these projections are artificial, these projections are not feasible, these projections are way higher than the historical data that you have produced before me, when an investor is trusting the same projections or the same forecasted data and investing so much money into the company? So over back to you, Mr. Gupta. It's an
I
interesting
think
world.
what you're talking about is a very, very interesting thing. So what you talked about. Again, my only point is challenges as a valuer. How you anticipate what you're talking about? One thing, investor already agreed to invest 1,000 crore rupees. So how a valuer is concerned, you have to only stamp the value. It is a statutory requirement, something like that. They will say like that. I agree with you. Lekin still some challenges must be there, na sir?
The challenges are with respect to for any DCF valuation, for any market-based valuation, when you go to the market for a startup valuation, you rarely find any comparables because the business model is a very unique model. You would not find, say you want to value Bhushan Steel or Tata Steel, you can say that, okay, this is the capacity of this plant, this is the kind of revenue they are making in the past. Let me compare the or maybe an unlisted steel company, you can compare it to a size of an equal or equivalent size of any other company and come out to a value based on the metric tonnage capacity of that company. But whenever we talk about a startup, we are not looking at any tangible asset, almost no tangible asset at all. Everything is intangible. Say the company has prepared an app and now it has users. Now, the quality of those users are also important. There is a system of weekly active users. Weekly active users is a term to define that how many users were active at least once in a week. Then there is a monthly active user, annual active users. When you look at these numbers and you look at understand these numbers, you will find that out of the total pool of say 4,000 application downloads that an app might happen, not even 40 might be active. So the active users is a very, very important number. So whenever we are valuing a startup, that is a number that we need to investigate. We can look for data that talks about how many of those people are, how actively are they using the app, the people who have downloaded any app or downloaded any software which the app is running. So the challenges are to know about all these terms which are used in the startup world and document this data in the valuation report so that the valuer is safe, so that the valuer is able to do a just valuation, and he has to see high growth in the past. If the valuer is not able to see high growth in the last 1 year, 1.5 years, then anticipating that suddenly there will be very high growth is a difficult proposition.
You're talking about the capturing the share in the market. I think this is a major aspect. Even you are incurring losses, even you are projecting the losses also, simply by capturing the share in the market. It is a major aspect for the valuation.
It is a major aspect for understanding the growth that a company will have. Now, let's take an example here. Let's take the example of Cred. What Cred is doing is Cred is collecting users. Cred today says that, okay, through the reward system that it has developed, it now has credit data of high net worth individuals and says that the pool of 10 million users that it has collected are all the cream consumers of the country. Now, Cred can very well use this data for pushing credit to these people, pushing products to these people, because they have identified people in the country who are holding very, very high net worth, and they have created a pool out of it. Now, they can use it in any way possible. Similarly, in case we talk about Paytm, because I have Paytm as a downloaded app on my phone, tomorrow if Paytm wishes to tap me for its insurance business, then it is easier for them to tap me for that business rather than somebody else who does not have that downloaded. So access to the customer, access to the market, having reach to the customer are also considerations apart from sharing market, because there is a space in my phone. I would choose maybe one or maybe maximum two UPI based apps which I want to use. I can try Bharat Pay, I can try Phone Pay, I can try Paytm. The app that I am accustomed to use, I will keep using that for lifelong. So imagine that maybe 8 years back, Flipkart and Amazon came in together. For the initial few purchases, I might have gone to both the apps together and seen the price and the availability of maybe a laptop or something that I want to buy. But after I start trusting one app, I will stop visiting the other and be reliant on one app, depending on which one I find better to use and more comfortable to use. So the idea is access to the customer.
You just, Mr. Goel, you just tell us what are the valuation methods and strategy can be employed to overcome the difficulties. Have any view on that respect of any valuation method? I think Manisha also covered so many methods, whatever suggestion, DSF or something like that. Have you anything in your mind?
Primary method for any startup valuation is the income method, where the income is negative. There, then we resort to market approach methods, where we are looking at uh, weekly active users or monthly active users and try to compare that with the market. Then normally startups, you have very recent transaction data which is available. There might have been a round of investment which has happened 1 year back, 6 months back for the same company. That data is also permissible to be used under IVS, so we also can use that data. But most reliance in any other case is placed on DCF, where you say that, okay, this is the business model of the company going future. How you have verified that, or how you have said that those projections are commensurate or in alignment with the historical growth and historical data of the company. And that is the valuation method that we normally prescribe. With respect to market-based data and market-based comparables, there these terms with respect to technological companies, with respect to how many users are there, some companies, that will be a very interesting thing to do. We were talking about WhatsApp. So WhatsApp was acquired by Facebook. WhatsApp was acquired by Facebook, and that was something that was talked about at length. How will Facebook monetize this? How will they earn money? But then I believe that the biggest gain out of that acquisition has been all the data integration that they could do. Now they are able to uh, target their users on Instagram and Facebook based on the data and the algorithms which have scanned the WhatsApp chats of somebody. So in case somebody on WhatsApp messages to his friend that I really want to buy a phone, can you please tell me which is the best phone available? Suddenly Instagram and Facebook will start pushing advertisements on phones to that person, making their advertisement algorithm a lot better than others. So that is one big asset that they acquired. So it's modern technology these days. We call this metaverse, we call this internet, we call this online platforms. Things work very differently as compared to the tangible world that we are living in, and therefore the methods also have to change. The units have to change based on the units which matter in this world.
Very nicely. There is one question, whether you can give some reply to this. I think it's the most important aspect. Mr. Atul is there. He's telling that then after 5 years of financial projections, what is the premium percentage given to the product? Have any view on that? 5 year
So
project?
I believe his this question is pertaining to the intangible assets.
Yes.
I can try and understand this question. So I think he's saying that when we do financial projections, it's a normal system to project 5 years of data which is coming in, and
Okay.
then after that you give a value to the company as its terminal value and say that we will not project data for beyond 5 years, assume normal growth beyond 5 years in case of a DCF. So he's asking that what premium percentage is given to a product patent. So I would say that it will always depend on the kind of patent we are talking about and its revenue generation capacity. In case after 5 years, the product patent still has, let's say, 20 years or rather 15 years of remaining life, because so 15 years of remaining life would still allow the company to maybe encash that product patent. So that is the kind of value that will be required to be estimated as part of the terminal value that is estimated after 5 years of financial projections. In many cases where there is a product patent and you can anticipate the growth in revenue based on the product patent for beyond 5 years, then you would rather take the full life of that product patent and try to anticipate the value of that product patent or income derived from that product patent for the longer period. That's how normally you will do. But at the same time, for any product patent, there is a risk of change in technology, the product patent being becoming irrelevant. All that needs to be factored in by the valuer when he's valuing that product patent or valuing the terminal value of that product patent.
Very nice. Very nice. Mr. Kumar is there. Kumar sir. Kumar sir.
Yes, I am there very much. Yes.
Sir, your last word. So, any viewpoint, because you must have listened to Mr. Manish and Mr.
No, I
Goel.
think it was a very enriching discussion.
Any suggestion from your side? Or
I have been practically associated.
sir,
Yeah.
you want
Are
to
you
say
able to hear me
something
now?
at last concluding remarks, Kumar sir?
Yes. Are you able to hear me?
I am hearing you, sir. I am hearing.
Okay. So it was a very enriching discussion. In fact, our two experts spoke very well about various methods and the issues associated with the valuation. I have been associated with valuation of two companies. In fact, one which I am a co-founder. So I found that there could be many ifs and buts with any valuation. It depends what is the agreement between the investor and the owner and the main promoter of the startups. So while various methods will throw different outcomes and different results, but depending upon the nature of business and the nature of factors which are important in valuing a company, will play a role in valuation of the company, and ultimately it leads to the conclusion that the investor or the user of that valuation has to be satisfied. So that is the crux of the entire valuation, because somebody who is putting the money, investing the money, maybe buying the company or investing part of the equity, or participating in the equity share capital or IPO, or he has to be satisfied. He or she has to be satisfied. And uh, you can use various methods, but different methods should not be so diverse. I mean, it should not be so diverse that every method shows a completely different picture. So it has to harmonize somewhere. The methods being used, one should use two methods, but be in harmony of the outcomes. So that is my observation. I would still feel that valuations are shaping up. Uh, while a lot of companies have been valued and we are in the uh, you know game of valuation for quite some time, but then they are still shaping up. New issues are emerging, and I'm sure the maturity level of valuations is going to still take some more time. So, so these are my observations.
Thank you, sir. Thank you very much. Manishi, have any view, you can say, you want to convey some message to the participants in respect of valuations? Any
Yes,
your
sir.
concluding remarks, you want to say something?
Yes, sir. Yes, sir. This is regarding intangible assets. So
Yes.
India has to focus more on brand building. So it has to devote more stress and uh, devote more research and development and more exercise on brand building. So that will create more intangible assets, because intangible assets has become the prime focus, core area of any valuation enterprise, business enterprise. And apart from them, startup is always a challenging thing. Start valuing a startup. So I have done few valuation of some startups.
Right.
So means getting the projections and figures and data are always challenging. So
And they
yes,
have any suggestion for the startup? Because some entrepreneurs are also with us, some bankers are also with us. Have any view? You want to convey something to these people? What they should do? Challenges are there. If what they can do.
to overcome those challenges means they have to start with from somewhere. Means they have to prepare some projection and then fine tune those things. That
Okay.
is the idea, sir.
But they should come out with the papers and projection and what
Yeah.
their idea they should put on the papers.
Yes, sir.
That's why it can be useful to these people.
Yes, sir.
Okay, Manish, thank you very much. I'm coming to Mr. Goel. Goel sir, have any view, last view, want concluding
No,
remarks,
I
want to say something?
no, I think startups is a very, very different field, and for all the VCs, PEs, all the enterprises which are aiming to be startups, the idea is very different. The measurement of the value, which is done by various investors who are willing to invest in the startup area, is on a very different idea. So initial investment happens based on the ability of the founder, the assessment of that ability, based on the product that the company is trying to develop, the area or the vacuum which the company is trying to fulfill, the existing players and the competition in that area, how fast can the company grow with after infusion of money. These are the critical questions that any investor will ask before investing in any startup. And the we can say that yes, every entity which starts today is a startup. Somebody who puts a thela in a market or in an area where there is no golgappe wala to start a market there is also a startup. But at the same time, when it comes to corporate India, when we look at all the news on the internet or we talk about unicorns, then we are talking about people creating a business model out of nothing. Nobody could have imagined that if somebody collects all the credit data of the rich people in the country, then he can make a company which is worth $4 billion. So that's the idea that has to click. And then there has to be a very, very strong and capable team to develop that. We have seen the co-founder of Zomato, who is a chartered accountant as well, having a net worth of 200 crores today because of ESOPs and because of being through a successful startup or a listing of a startup. So that is the kind of opportunity that startup provides, and it's something which is a very, very interesting world. We are also closely engaged with so many companies which are working towards becoming a successful startup. And I believe that there's a lot of effort that is put in when you want to have that kind of result that we have seen in Zomato, Paytm, Nykaa, and so on.
Very nice, Mr. Goel. I think you have touched a very real point because this webinar actually meant once you are talking in a group to have an investor, very, very difficult for a startup. Valuation is the major aspect. I think today webinar put all the challenges and outcome also. And what are the difficulty, how you should come out of the difficulty. Challenges are there. Like how you come. I think this webinar is a very practical webinar. Instead of putting any theoretical things, we have talked from our heart, from our experiences. And we are thankful to Mr. H.P. Kumar, who are very experienced. You can say, I must say, banker, and you can say the leader, and he's a ex-chairman of the big organization, government organization. And his experience, I think, will be also benefited to the participants who are with us today. And we are also thankful to Mr. Manish, who is also very practical person and done so many valuation in respect of that. And his expertise in the valuation also. And he also talked from his heart. And he told so many methods of the valuation and what are the difficulty envisaged by the startup, how they can be useful to us. I think that is the point Mr. Manish was telling. And Mr. Goel, I thankful to you. I think you are a very vast knowledge on this subject. You also touch very rightly. कि एक गोलगप्पे वाला जो है वो भी स्टार्टअप है. Really very important aspect you have talked. We are thankful to you. We are thankful to Mr. Kumar, Mr. Goel, and Mr. Manish also. So today we could not welcome our respected Manoj sir, who was General Manager with Bank of Maharashtra. I think he stuck up with some meeting. So we have been deprived to listen to his viewpoint also. So we as a Association for Financial Advisor of India, his main objective is to impart knowledge among the financial advisor, among the financial people, among our members, among the bankers, among our entrepreneurs. So as I told you from the beginning that more than 600 registrations are with us, and we will send you the total list who have attended this webinar, and recording also be sent to you. And I am requesting all the professional people, they can also become the members of this association, which it will be very,
क्या कर रही है?
it will be very useful for the financial professional people. And also I'm on the board of the Research in India, who is a merchant banker, who is investment banker, who is conducting viability study, giving a training to the bankers, organizing so many webinars to impart the knowledge. Besides that, we are in professional also in respect of the conducting technical viability study and arranging the funds for the entrepreneurs. On behalf of the Research in India, from the Association of our Financial Advisor, I'm thankful to them. We are also a team who is behind the cameras. So they are from IT team, from where Mr. R.K. Parida is there, and my Surinder is there, who is a director of the association also, and Mr. Lokesh is there, Mr. Devas is there, and all the IT personnel are with us. So I'm thankful to them who has managed this webinar very excellently, and thankful to them. All webinars are being conducted on the request of our members. So this topic was discussed. Now next week we will also identify some questions, some webinar, some points also. Accordingly, we will hold the another webinars for that. And thank at the end, I'm closing the session with the thanks to my eminent speakers, Mr. Manish, Mr. Goel, and Mr. Kumar.
Yes, sir.
Thank you very much. Thank you, sir.
Thank you.
For
Thanks a
your
lot.
Thank you, sir. Thank you.
participation.
Thank you, everyone.
Thank you,
Thank you,
Gupta ji.
everyone.
Thank you very much.
Thank you very much.
Bye, sir.